Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Hi everyone. How was your teaching break? Good? Stressful? Busy? How many people still have mid-semester exams this week? Okay, in that case, thank you for coming actually. Given that a lot of you do have exams, I looked around the room and I'm like, I can't tell. There's less people here, but not as little as last week. In week 6, there was, 10 of us in the room? So it's good to see that people are coming back as mid-semester exams get done. Now, a couple of things before we begin. The first is our own mid-semester exam. I want to apologise. I really did want to get the marks up during the break because I remember as a student that pain of waiting for marks to come up. They were actually marked a week ago, but there was a surprising number of students that actually, unfortunately, did the multiple choice very well, I might add, a lot of the time, and didn't actually put their ID in at all, or put it in pen or something that the computer didn't pick up. So our admin team have been finding those scripts. I don't know if they've found them all yet, but I know they found a lot of them, and we're slowly matching the multiple choice script to the person that doesn't have a multiple choice mark. So hopefully they should give me the completed marks in the next day or two. I don't know yet whether there might be the odd student that doesn't have a multiple choice mark, in that we have a script but we can't tell whether it is their multiple choice script. If that happens, we'll find it and we'll match it and there will be a solution. But I will, when I put up the marks, I will put up a post on Waddle just confirming whether or not all of the marks have been entered or whether someone out there might have a mark for their written answer but not for their multiple choice, if that makes sense. Just a heads up, whenever you do have multiple choice, don't just mark it, don't just do your answers in pencil, do your ID number in pencil as well, because remember it's the computer that actually picks that up, so otherwise we need to go through and find the ones that are missing. Now, I don't want to talk too much about the mark breakdown because I haven't actually seen the full distribution. My tutors say that they were impressed with the quality of responses, which is great. But until I see what the average is and everything, I don't want to tell you guys that you did really well and then accidentally find out that the average was lower or anything. But from what I can tell, things are looking good. How did you guys find the exam? Was it, I mean, I don't know that anyone's going to tell me it was easy, but was it shockingly different to what you expected? Was it about what you did expect? I don't know why I asked the class as a whole. I never get answers. I'm waiting for one day when someone goes, yeah, Anna, it sucked for this reason. But look, if you do have it, some people gave me some feedback on the exam in the mid-semester course feedback link, which was great. And typically the feedback that I got from the exam is that it wasn't too hard, it didn't make it easy, but it was very applied. And for the most part, I didn't seem to get a lot of kickback on that. I didn't get any comments saying that the exam sucked or anything like that, which I'm pleased about. But if you do have any feedback on the exam and you didn't want to put it there, but you want to talk to me or email me, please do. Now, a little bit more about that course feedback. Thank you for everybody that did fill it in. I really do look at it carefully and I adjust my teaching for the second half of the semester as a result. So I appreciate your comments. First of all, I'm really glad to see that people seem to be really enjoying the course. They like that it's applied. They do say it can be a lot of work. It is a lot of work, but for those of you that commented and said that you're enjoying it, I'm so pleased about that. They also, by the way, just so you know, the conclusion from those that filled in the course feedback link, the majority said that they preferred the fortnightly tutes to the weekly tutes. About a third of you would have rathered weekly and 2/3 fortnightly for those that filled it out. Always with the comments that the videos obviously made the difference in enabling the fortnightly tutorials. If you have any more feedback on how you're finding the fortnightly tutes, please do let me know. Either send me an email, come and see me, or write it in the end of semester evaluations if you didn't write it in the mid-semester evaluation. I only started this system of videos and fortnightly tutes last time I taught the course, so I'm still tweaking it as we go. A couple couple of things did come out in terms of tweaks that you would like for the course for the rest of the semester. The one that was pretty consistent is that you would like a bit more content on the slides. Now, I keep them, I mentioned last week, relatively, I don't put everything I say on the slides, one, because examples change, and two, because I don't want to encourage rote learning, but I completely understand why you would want a bit more content. So you ask, I deliver. What you'll see today and for the rest of the weeks is that I am beefing up the slides as we go. So essentially what I did over the break is I took all of the lecture slides for the rest of the course and I added content in bits. I didn't add in massive slides, but I added extra content in a lot of the slides in areas that I thought it might help you guys to have that memory trigger rather than writing it down. I might, as I prepare for each week, do that a little bit more. So I guess what that means, because I am trying to add in a bit more content, if you're someone that wants to download it all ahead of time, just keep in mind that in the week, in the lead up to the lecture, when the lecture notes are available, I may actually add a little bit extra in those final days. So if you're going to print it off, probably print it off the day of, unless you like to revise ahead of time with it written down. In which case, if you see a note on the lecture slides that wasn't on the printed off version, just add it in as we go. So that was one. The other one is that there are obviously a lot of people listening in from home, and people have asked if someone asks me a question to repeat the question before answering it. So I will remember as much as I possibly can to do that. It's fair enough. I mean, if you're not here, if you're listening from home, you just hear my responses, you don't hear the questions. So I'll do that. The third, which is one that I've got comments about this in the, how old am I now? God, nearly 10 years that I've been teaching. When I get excited, I can talk too quickly. You guys are probably, as you guys know, I do try to remember not to do it. The trouble is when I do get passionate, that thought goes out of my head. I'm never offended when people tell me to slow down. So even in the middle of the class, if I'm talking and my pace starts to increase, feel free to put up your hand and say, Anna, you're doing it. Bring it down, slow it down, repeat it, okay? I'm going to keep trying to remember it. I wish I had I wish I could get my watch to buzz and tell me to slow down as I talk. But please don't feel embarrassed telling me to slow down. I won't be offended. If you want me to say something again, let me know, and I will try to do a better job of staying slow as I talk. Any questions about anything before we start the lecture? Okay, so what we're doing today is fixed income. Now, if you weren't in the lecture on equities, I hope you have listened to the recording, and if you haven't, please do, because these weeks are all about deepening our understanding of the different asset classes, and in a large part where that's going to be valuable for your assignment is in the qualitative arguments that you use to tweak whatever comes out of your quantitative analysis, right? Because Solver, for example, can understand what it means to have an expected return. It can understand how to calculate standard deviation or probability of loss. But it can't understand the key exposures and drivers of an asset class. It can't predict, without you giving it data, how that asset class might perform in a time of deflation, because it pays, in this case, for example, nominal coupons. So what we're doing in trying to deepen our understanding of each asset class is we're trying to be better at interpreting the output that Solver gives us and tweaking it accordingly. Because the classic example I always give, Solver doesn't understand that property is appraisal-based valuation and therefore that results in smoothed returns, lower standard deviations. But we do, right? So it's things like that. The other reason these weeks are going to be good for your assignment is, remember, your investors have asked for an overview of all asset classes. So if you're going to give an overview about the risk and return features, whether how easy it is to implement, this is where we're going to be starting to look at that kind of stuff. So I think fixed income is one of the more interesting asset classes to look at, because with equities, equity is such a big risk-return driver for our multi-asset class portfolio that the risk to equity is a risk to our portfolio overall. Fixed income is different. It's not a big risk return driver for a multi-asset class portfolio. So what we're going to see is that the biggest risk to a fixed income portfolio on its own completely disappears when you combine it with other asset classes, because it gets diversified away. Right? And one of the risks, another big risk to fixed income, actually has diversification properties within fixed income, but not in a multi-asset class portfolio. Right? I'm talking about interest rate risk and credit risk, and we're going to go through a lot of graphs and reasoning as to why they're the case. But the reason fixed income is different to equities in that respect is a big risk to equity is a big risk to a super fund. A big risk to fixed income is not necessarily a big risk if you're in a multi-asset class superannuation portfolio, which I think is really interesting. So what we're going to do is we're going to start by looking at the role of fixed income in a broad multi-asset class portfolio. And we're then going to go into the risk and return properties of fixed income, first in a fixed income portfolio in isolation, and second, back into that broad multi-asset class world. Okay, so I'm going to always be talking about two different types of portfolios today. One is a fixed income portfolio on its own. So what I mean by that is you hold fixed income and only fixed income, nothing else. You don't have equities, you don't have alternatives. And then I'm going to be talking about fixed income in a total portfolio. In other words, I have equities, fixed income, commodities, hedge funds, private equity. So within that portfolio, fixed income is maybe 13% of the weight, 18% of the weight, whatever it may be. Okay, so we're talking about a traditional superannuation portfolio that has a decent weight in fixed income, but a larger weight typically in equity and a weight in other asset classes too. That distinction doesn't typically matter with equities, but it does here. And the reason is this point here. As I said, there are contrasting implications of the key risk return drivers of fixed income if you look at the asset class alone or in the multi-asset class super fund. You can see why that is if you go back to the graph we looked at last week with equities, right? Equities, 93% of the variation in equity return 93% of the variation in super fund return can be explained by variation in equities. So if you're looking at your super fund volatility and trying to figure out what the key risk sources are, the first thing you should do is look at the equity market, because that's the big risk return driver for your super fund. But fixed income on its own, both Australia and world fixed income combined, only explains 11% of the variation in super fund returns. Right? So the big exposures within fixed income aren't really affecting superannuation volatility. So because of that, we really need to be careful whether we're talking about an exposure to the asset class in isolation or a multi-asset class portfolio. And we're going to finish with ways to access fixed income investments. So remember, I always say there's those two portfolio perspectives we're taking. What we're going to start with is looking at the role of fixed income when you put it as part of a broad multi-asset class fund. I think everybody would probably think of the first reason, or the first role of fixed income in the fund, and that is that it reduces risk. Right? It essentially acts as what we call a ballast for the portfolio. Now, a ballast is something that you use on a ship to provide stability. That's exactly what fixed income does in our multi-asset class fund. It reduces the volatility and stabilises returns through time. Now, we're not even talking about diversification yet. We're talking about a pure averaging effect. The fixed income standard deviation is lower than an equity standard deviation. So when you add fixed income into a fund in addition to equities, average risk goes down. If you've watched the recording, or if you were here in week 6, does anyone remember about what the average standard deviation is for an equity market? 18%, including the Great Depression, 15% if you remove the Great Depression. That's right. So we're looking in a range of about 15% for equities. To give you an idea of just how much fixed income can reduce volatility just on an averaging effect, this gives you the 60-month, so 5-year rolling standard deviation of Australian fixed income in the blue and world fixed income in the black. Now, I'm going to talk about the downward trend when we come back to this slide. But have a look at what it's been over the last couple of decades. We're talking about sitting in a band of 3% and a bit lower, right, versus 15% for equities. So essentially, fixed income has a risk at the moment that's about a fifth of that of the volatility of the equity market, right? So if you have 50% fixed income and 50% equities, think about how much that's going to reduce your volatility versus 100% equities. So that's the first role. It is a lower risk asset class, so it's the first thing you think of when you want to bring the risk of your portfolio down. But the second thing is, remember, we don't just reduce risk through the averaging effect, we diversify risk further as long as asset classes aren't perfectly positively correlated. So fixed income will help you to diversify your risk. To an extent, it will help to diversify economic risk, but remember, at the end of the day, the economy is the classic non-diversifiable risk source. What we mean by it will diversify economic risk to an extent is we will be less exposed to economic fluctuations if we include fixed income than if we don't, but that doesn't mean it will eliminate economic risk altogether. That's impossible to do. Sorry. So that's one thing. If you think about what happens when think about the GFC. When the GFC was occurring, equities were plummeting. The property market was doing really, really badly, particularly in the US, right, where the where the property bubble burst. Australia property market was still all right. Fixed income wasn't doing well, but the returns were at least marginally positive, right? So it will help to protect you against some of that economic fluctuation. The next thing it's going to help to protect you against, and in fact give you benefit from, is times of deflation. Now, we've spoken about inflation already. How would you define deflation? Yes? Yeah, absolutely. Well, it is. Yeah, it's negative inflation. Okay, so when you have a time of inflation, what's happening to the purchasing power of your goods? So with deflation, it goes up, right? So people tend to at first think, well, there's nothing wrong with that, right? Better and better. We can buy more and more with the same dollar. The reason that deflation can be a problem, well, people say it's insidious and that it creates issues after issues, but the way to think about it in the context of this course is when deflation can occur. Deflation, by the way, is very, very rare. It happened big time in the Great Depression. Luckily, it doesn't happen very often anymore. But times of high inflation tend to occur in market booms. When the market starts to turn into a contraction phase, that's where the risk of deflation is, when the market's going down. So when the market's going down, you're risking having a time of deflation. At this time, equities are going down. But what happens with bonds is if you have a nominal coupon-paying bond and you keep holding it, then equities is going down. That's being partially offset by purchasing power going up. But your nominal coupons, you're going to keep getting the exact same coupon, even though the economy is going down. You're still getting your nominal coupon. And on top of that, that nominal coupon is buying you more and more as deflation occurs. Okay, so at times when the economy is doing poorly, the purchasing power of your dollar is going up, and you have an asset that is giving you a consistent dollar return. You need to keep holding these bonds, but if you have nominal bonds and you keep holding them and just collect the coupons, every time you get a coupon, it's actually able to buy you more and more as deflation kicks in. And the other thing is it is a good diversifier of equity specifically, particularly in times of economic decline, and I'll come back to that in a couple of slides. But to give you an idea of the correlation structure between equity and fixed income, what you can see is in the blue, world equity hedged and world fixed income hedged, and in the red, Australian equity and Australian fixed income. And you can see that since the middle of last decade, so since about 2006, both have been negative. They've been dropping since the start of the century, the correlation between the two assets. So you can see that the ability of fixed income to act as an equity diversifier is improving through time, through the first decade of the 2000s, and it's now levelling off. But even then, for Australia it's negative, for the world it's zero. Right? This is a really good correlation when it comes to diversification between asset classes. So when we know that equity is the key risk-return driver in our portfolio, we've now got an asset class that's going to help to diversify the equity risk per unit of return. By the way, I'll come back to this, but the other thing with correlation that you can see is that the correlation tends to be negative in equity market crashes. We've got the Great Depression, the dot-com bubble and the GFC, which means that fixed income is a particularly good diversifier of equity risk when the economy is bad, equity is bad, job risk is high and everything's going to pot, right? So it's actually a very valuable correlation structure to have. Okay, so second role, fixed income will diversify your risk. Third role is if you are a liability-driven investor, fixed income will help you with your liability matching. Right? Remember, if you think back to week 5, if we want to find our minimum risk position as a liability-driven investor, do we tend to invest in fixed income or equity? You know how there's been high surplus risk in defined benefit funds? What was one of the reasons for the fact that historically there's been quite a high surplus risk? Equities, people have been investing, so in defined benefit funds, remember in week 5, we said that historically they've tended to invest quite a large weight in equity. That created surplus risk because equity is a more volatile asset class. Whereas if you want to minimise the surplus risk of your portfolio as a defined benefit fund, you tend towards fixed income. It's more stable and it tends to be a better match for liabilities. Fixed income is both an asset and a liability itself. So if you are a liability-driven investor, you can reduce your surplus risk by matching your assets and your liabilities. Remember, if you're reducing your surplus risk, though, what else are you actually reducing? The expected return, the expected surplus, right? So it's not all good, right? You reduce your risk, you reduce your surplus too. But if your goal is to get a better match for your assets and liabilities, fixed income is typically the way to do it. The fourth potential role of fixed income is that it is a potential source of alpha generation. The reason I've put possibly there is that there's a lot of contention as to whether, on average, fixed income managers do create alpha. Some studies say they do, other studies say they don't. The main reason for that is that there isn't a very good alpha model in fixed income, right? In equities, we've got the CAPM, we've got Farmer French, we've got Carhart. Fixed income, we don't have a nice model where we can pop the returns in, assess it against a market risk factor, and the alpha will pop out. It's quite hard. Number one, it's hard to measure alpha to begin with. Number two, as we're going to learn, risk means different things to fixed income managers and end investors with multi-asset class funds. 3, passive options in fixed income are way worse than in equities. It's quite hard to track a fixed income index. So with all these reasons, it's actually quite hard to break apart what is the return from skill, right? What's alpha, and what's the return from risk, so what's beta. What you do tend to have with fixed income funds, even if they do arguably outperform, they tend to do things like bet on interest rate direction, right? So first of all, if yields go up, what happens to bond prices? They go down. So if you expect yields to rise and you're holding a lot of fixed income, what will you do before yields go up? Sell. If you expect yields will drop, what will you do before that happens? Buy fixed income, right? So you tend to bet on interest rate direction. And remember, just like we said with market timing in equities, if that's what you're doing, it becomes quite hard to figure out what's alpha and what's beta. Because in any one period, you're getting a return that's in line with the risk strategy you've taken. It's only when you add it together that you start to see a fixed income manager performing well, irrespective of whether interest rates are rising and falling, by adjusting their duration, essentially. They also tend to do well by taking on credit exposure. Now, this is another thing where it's really hard to figure out whether it's risk or skill. What does it mean when you take on an investment that has higher credit exposure? What are you doing? Sorry? Actually, you are. You're purchasing more junk bonds, right? Or you're purchasing bonds of lower credit quality, but the classic example is you're buying junk bonds rather than investment-grade bonds. When you take on credit exposure, there is a higher probability of default, and that therefore carries a higher return. Now, if all you're doing is buying a bunch of bonds that have a higher return because they have a higher probability of default, and they're not defaulting, so you're getting a good return, two things could be happening. One, you might be genuinely identifying bonds that the market thinks has a high chance of default, but you know that they're safer than they appear. So you're benefiting from the higher return, but they're not defaulting because you've correctly identified that they are actually a better prospect than the market thinks. That's skill. The alternative is you're buying a bunch of junk bonds. They happen to have not defaulted, so you're getting a very good return, but you're just lucky, and it's pure luck that they haven't defaulted. The economy hasn't turned bad, business is going pretty well for now, but there's no real skill in you identifying that. So again, it's hard to figure out with fixed income what's alpha, what's skill returns, and what's risk returns. And there's a whole bunch of problems with fixed income benchmarking and performance evaluation, and we're going to go into that at the end of today. So we've already talked about this graph, but there are a couple more things I want to raise attention to when you look at this is the risk of fixed income on its own through time. The first thing is, well, we've already said the level of fixed income standard deviation is a lot lower than equity in general. The next thing I've written at the bottom here is fixed income standard deviation is falling over time, both at the world level and for Australia, although it's much more extreme in Australia. And the third is that Australian and world fixed income risk is converging through time. Back in the 1990s, Australian fixed income had a much higher volatility than world fixed income, but they've now started to level out. And they're a lot more similar now. Which is one of the things, and I don't expect you guys to adjust for this in your assignment because I've given you expected returns. But it's one of the things that if you were going to model the risk return of the two asset classes, you'd need to keep in mind. So again, you don't need to do that for the assignment. Your investor has told you what returns to use. But it is one of those features where in Australia, fixed income risk is lower now than it was at the end of the previous century. The other thing I want to point out here before I move on is that the line here is world fixed income hedged. In equities, if you think about the tutorial work you're doing or the work you're doing for the assignment, remember we've got Australian equities, emerging market equities, and then we've got world equities unhedged, and we've got another line, world equities hedged. That's because equities is typically the market where people will play with their currency risk and their hedging decision. You tend in fixed income, the majority of managers will hedge away currency risk. There are some managers that do take on currency bets in fixed income. Most of them hedge currency risk away. It's equities where you're going to play with the optimal hedge ratio. So we're going to come back to that in week 10 when we look at our global investing, but I wanted to just flag, in case any of you wondered, the reason that we don't have world fixed income unhedged is that is far less popular in world fixed income investing than in world equity investing. All right, so we've had a look at the roles of fixed income in a multi-asset class portfolio. We're now going to move into the risk of fixed income, and remember we need to do that in two different perspectives. What we're going to do is we're going to start by saying these are the big risks that affect fixed income on its own. And then what we're going to do is we're going to take the two biggest risks for fixed income and see how they behave within a multi-asset class fund. They're listed in order of magnitude. Interest rates are the biggest exposure by a long way in fixed income portfolios. currency is the smallest, and sometimes, most of the time, people hedge currency risk away. Currency is included for the small proportion of managers that do actually have an unhedged world fixed income investment. Okay, so exposures within fixed income, the biggest one is interest rates. Now, I'm guessing you guys you already know this, you would already be thinking about why it is. And what you'd probably think about is the first of the two reasons I've listed here. When interest rates go up, you've told me bond values fall. When interest rates fall, you've told me bond values rise. So obviously changes in interest rates are therefore going to change the value of your fixed income investment and your return with it. But just in case anyone feels a bit rusty, this is your classic simple example. You've got your investor Jack. It's just showing you numerically how there's that inverse relationship. So Jack has bought a 6% semi-annual 20-year bond at par. What does it mean if we say at par? Interest rate is 6%. Yeah, so at par, I had three answers and they were all right. The first is at par means the face value is 100. The second was at par means the face value is 100 and equals the bond price. And the third is that if it's at par, the coupon rate and the yield are the same. So when you trade a bond at par, it means that you're paying an amount equal to its face value of $100. If the price equals face value, the yield is equaling the coupon rate of 6% in this case here. Essentially what it means is the yield is the return that you require on the bond, the coupon rate is the return that you receive through regular interest payments. If they're the same, if the return you require is the return you're getting through the coupons, then you don't need to get any additional return by having a difference between price and face value, right? All of the interest is being paid through the coupon. All right, so you're going to start with a bond with a price of 100 and a yield of 6%, which matches the coupon of 6%. If the yield goes up to 6.5%, does the coupon percent change? No, right? Because think about it. When you create a bond, you create it with certain conditions. And there's no way that you're going to sit there saying, all right, at the moment, the coupon is 6%, but I'm going to create a facility such that I'm going to adjust that payment at all points because remember, the reason coupon bonds are called coupon bonds is that back in the day, they actually literally were a piece of paper with coupons you'd tear off to get your payment. You're not going to be able to adjust the value of those coupons through time. So because you can't adjust the value of the coupons through time, what you do is adjust the price of the bond to compensate. So here, the yield has risen to 6.5%. So for whatever reason, this bond has become perhaps more risky, so investors are demanding a higher yield. They're not going to get that through coupons. So if Jack wants to sell the bond, to persuade anyone to buy the bond, they won't buy it for 100 because the coupons aren't giving them enough return. The only way they'll agree to buy it is if they pay less than 100, so that 6% of their return comes through the coupons. The extra 0.5% of the return comes from the fact that they pay less than face value, so they pay less than 100, and they're repaid 100 at the end. And that difference is the extra kick of interest that they get. So in this case, Jack will have to reduce down the price to $94.45, and that will give you your 6.5% return overall for the buyer. Or if the interest rate goes down to 5.5%, now the coupon, you're getting a 6% return through the coupons, but investors only need a 5.5% return. These are efficient markets, right? So if you only need a 5.5% return, that's what you're going to get. Otherwise, someone else would come and trade the bond from under you. So essentially what happens is, all right, I'm going to buy the coupon. I'm going to get a higher return than I really need. So I'm going to compensate the seller for that by buying it for a bit more than that face value that I'm repaid at the end. So in that case, the bond price will go up to $106.02. So always keep that in your mind. Yield goes up, bond price goes down. Yield goes down, bond price goes up. So that's the biggest, that's the most common way that people will think of interest rates, changes in interest rates causing fluctuations in portfolio value. And it's the biggest way that they do it as well. But there is another one, and that's changes in your reinvestment rates. And the reason I think that people don't really consider that part is that it isn't included in your bond price equation. What do we mean when we talk about reinvestment rates? What are we reinvesting? Coupons, right? If you buy a 20-year coupon bond like Investor Jack, right, it was 6% coupon rate, so a $3 coupon, or let's call these millions, $100 million face value. This bond is going to pay a $3 million coupon, right? So 6% divided by 2, because it's semi-annual, is 3%. Apply that to a 100 million face value, gives you a 3 million coupon every 6 months. So, all right, you've invested at a time of a yield where the yield is 6%, but 6 months in, you're going to get your first $3 million coupon. You're not going to put it under the mattress. You're going to invest it. If yields have changed between when you bought the bond and when you receive your first coupon, that $3 million will be reinvested at a different rate. 1 year in, you're going to get another $3 million, and you're going to have to reinvest it at a different rate again. What would you be worried about interest rates doing in terms of the reinvestment potential? Dropping, right? Because you started investing thinking, great, I'm going to get a 6% yield. You're going to get your first $3 million coupon. If yields have dropped to 5%, reinvestment rates have dropped to 5%. So you're going to get a lower return on that $3 million when you put it back into the investment market. A year later, you're going to get another $3 million. If yields are 4%, you're getting a lower return when you reinvest that coupon as well. Okay, so investing isn't a single period game where everything goes in at the start, everything comes back at the end, and you're done. Right? You're going to get cash flows, you're going to have to reinvest them. Even if it's a zero coupon bond, if you're in a multi-period world, you still have reinvestment risk. Because, all right, you don't have coupons, but what happens? You put money into a zero coupon bond, you get repaid the face value, then what? You're going to reinvest it, right? Unless you are actually a single period investor. And if you're investing in zero coupon bonds in a super fund, then you're not going to be a single period because you're talking 60 years or, all right, 40 years. And zero coupon bonds don't last that long. So every time you get repaid the face value, you need to reinvest it. And again, if rates are dropping, that's where your risk is lying because you're not going to get as good a return in future periods as you did in the prior period as well. So interest rates are the biggest exposure. The second biggest is credit risk. It comprises a few different things, but most commonly it's sort of as the risk of default, right? The risk that you're not going to be repaid what's owed to you. That's the focus of the second half of the lecture, so I'll just leave it there for now. We're going to spend a lot of time on that. The third is liquidity. Now, this is one that people can forget because we do call bonds a liquid asset class, and it is. Right? When you think about what your investors in the assignment have told you is counted as illiquid, bonds aren't one of them. Right? Bonds are classed as liquid asset classes. They're not like infrastructure or property, direct property in particular. But they are less liquid in general than equity markets. So, for example, a lot of bonds are traded over the counter rather than on a centralised exchange. If it's traded over the counter, is that more or less liquid than exchange traded? Less, right? Because you're matching up buyers and sellers. The second thing is that there's a difference between what we call on-the-run and off-the-run bonds. Can anyone tell me what an on-the-run bond is? It's the most recent issue of a bond. So let's say that you're the Australian government and you're going to issue a 10-year bond today, and then you don't issue another 10-year bond for a year. For the next year, the 10-year bond that you've just issued is going to be considered on the run because it is the most recently issued 10-year Australian government bond. But a year later, you might issue another 10-year bond. The second you do that, the newly issued bond becomes the on-the-run bond, and the one that was issued a year ago becomes what we call off-the-run. Off-the-run bonds are much less liquid than on-the-run bonds. And typically, as you move towards maturity, the liquidity of the bond will dry up. So, first of all, over-the-counter bonds are less liquid. Second of all, off-the-run bonds are less liquid than on-the-run bonds. Third of all, equity is still the most popular investment vehicle, which just gives it that added boost for liquidity in general. And the fourth one is that, unfortunately, particularly recently, the liquidity of fixed income has tended to dry up when people have needed it most, and that's in times of economic crisis. Right? In the GFC, the credit market dried up completely. So there are liquidity issues in fixed income. Don't assume that makes it an illiquid asset class. It's not, but it's certainly not as liquid as equity. Does that make sense? So it's not a massive problem, but it is a problem when you compare it with equity. Now, that said, it does depend on the market. The US Treasury bond market is very, very deep, very, very liquid. But even then, when a US Treasury bond moves off the run, liquidity does very much drop compared to when it was on the run. The fourth exposure is optionality and therefore volatility, because the second you have options involved, it does induce volatility in the payoff structure. Now, options can come into fixed income in a few different ways. It could come in through a corporate bond with a put or a call attached. Now, a callable bond means that you can repay the bond early. It's the option to repay the bond early. A put feature means that you can require repayment early if you're the lender. The redemption option in a mortgage-backed security means that it essentially means that the borrower in a mortgage-backed security can choose to repay the loan in its current terms and refinance it under a new interest rate. So think about it. We're investors, we're lenders in the mortgage-backed security market. We hold this mortgage-backed security and suddenly it's going to get repaid. So you might think, great, I'm getting repaid, that's a good thing. But remember this issue of reinvestment rates. When are people going to refinance their mortgage at the current interest rate? When rates have gone up or down? Down, because you want to pay. No one's going to say, please, I'm paying 8%, but let me pay 10% on my mortgage. It's not going to happen, right? So what's going to happen is I've got a mortgage-backed security where I'm getting an 8% interest rates drop to 5%, and everyone's going to go, you know what, I'm going to repay that 8% loan and refinance it at 5%. Suddenly I have my money back when reinvestment rates are low. So that's actually a risk for us. And the fourth one is sometimes currency. Usually it's hedged, but some managers will actually keep a currency exposure in their portfolio, in which case they have currency risk. So the biggest we've said here, exposure is interest rate risk. To give you an idea of how big an exposure this is, and remember, it's not about, I don't need you to understand every single item that you see here, it's taken from a reading, but it's about getting the key message from it, and the key message that I want to pass on in this table is essentially looking at this line here, the Australian government bond yield and the US Treasury bond yield. What we have in the first part is the percentage of Australian fixed income return variance that can be explained by these three items here. If you focus on this top line, 75%, 3/4 of the variability of Australian fixed income returns can be explained just by changes in 5- and 10-year bond yields. Right? So 3/4 of the variance of AFI as an asset class can be explained just by changes in interest rates. That's why we say it's the biggest driver. That's a huge percentage explained. The other two lines, when you add in equity return to the regression, explanatory power barely goes up. Now, you might think, why would equity explain fixed income return? The reason will become clear later on, and that is that junk bonds, the higher risk corporate credit, acts a lot like equity. But in the Australian equity market, there is very little junk investments. So that means that there's not a lot acting like equity. So that will make a bit more sense later on. World fixed income, the interest rate differential we're going to come back to in lecture 10, but that will explain 8.8% of the return. What I want you to focus on here is the second line. If you add in just the change in the US Treasury bond yields, 5- and 10-year, we're explaining half of the variation in the world fixed income return. Right? So, all right, that's not 3/4, but we're talking about US yields. One country explaining the variation in global fixed income returns, and it's 50%. So interest rates are easily the biggest exposure when you look at the volatility of fixed income returns through time. When you add in equity returns, you get a little bit of an extra boost to explanatory power. That's because there's more junk bond in the global market space. We'll come back to that in the second half. All right, so we've said that interest rate risks are the key driver of a fixed income portfolio on its own. Before I go to the next slide, let me try to get you to the headspace where you can essentially answer the first graph I'm going to show you. The way that we proxy for interest rate risk is duration. Now, can someone tell me, if you have a long duration, when interest rates go up, is the price going to go down by more or less than if you have a short duration bond? More, right? That's why we say that duration is a proxy for interest rate risk. The longer the duration, the more sensitive the bond's price is to changes in interest rates. So, if I look at just fixed income on its own, and I look at the volatility of the fixed income portfolio returns, as I increase duration, what do you think will happen to the volatility of the fixed income return? Yeah, but it will go up, exactly, right? Because remember, the longer the duration, the more sensitive the bond price is to changes in interest rates. So if interest rates are changing through time, as they inevitably do, if you have a long duration portfolio, the volatility of that portfolio is going to be higher than if you have a short duration portfolio. That's what you see. Ignore the graph on the right for a sec. That's what you see in this graph on the left. We're using duration as a proxy for interest rate risk. And what you can see along the bottom, this is a portfolio of cash investments, so very short time to maturity, short duration. This is 7 to 10 year duration, so that is your longer term bonds. And you can see the volatility of these portfolios goes up and up and up as the duration of the portfolio gets longer, because exposure to interest rate risk is increasing as you move from left to right, and interest rates are the key drivers of fixed income return and volatility. So what we have on the left shouldn't be a surprise. We're just saying interest rate risks are the biggest exposure, so the more exposed you are to interest rate movements, the more volatile your portfolio will be. So if you're managing a fixed income portfolio in isolation and you want to keep the risk of your portfolio low, one of the first things you'll think of doing is keeping the duration of your portfolio low, right? Because when duration is short, there's not that much fluctuation with changes in interest rates. Is everyone happy with that? Any questions on this side? Because this is where it gets really, really cool. If investing can be cool, which I think it is. Okay, so this is your massive risk, right? Now, you're an end investor. You hold a multi-asset class portfolio. In that portfolio, you've got 30% Australian equities, 30% world equities, 10% in Australian property, 13% in Australian fixed income. I want you to focus on that one. 13% in world fixed income, 4% in Australian cash. That is your portfolio at all points in the graph, but within your 13% Australian fixed income, what's changing is here, that 13% is in cash, here, that 13% is in long duration bonds, right? So the same portfolio broadly, but the one difference is as we come along here, the duration of the fixed income investment is expanding. So as you move from left to right, interest rate risk is rising because this is what is happening in that 13% in isolation. But what we have on the y-axis in this graph on the right is the total portfolio volatility. And this is where the magic happens. Interest rate risks are a massive exposure on the left, but as you increase interest rate risk in a multi-asset class portfolio, there is no increase in overall portfolio return whatsoever, right? If anything, the line is slightly negative. Don't read into that. The negative isn't significant, but it is flat, right? So what we're saying is, look at that. The second you've got a diversified portfolio, the biggest risk disappears. It just doesn't affect returns whatsoever, which is pretty amazing. Now, obviously, if we had a portfolio that was 90% fixed income and 10% equities, it wouldn't work in the same way. But in your typical superannuation fund, the type of weights you see in tutorials as well, interest rate risk disappears. The reason for that is, remember that low correlation between equities and fixed income? Equity risk is essentially able to diversify the interest rate risk away entirely. And I'll dig a bit deeper into some of the reasons why later on in the next slide. But before I do, this is where you have a bit of a conflict of interest in fixed income investing. You guys are end investors, you have a multi-asset class fund. You've given your fixed income investment to me. I am a fixed income fund manager. I am evaluated on how my fixed income portfolio performs. I'm not evaluated on how the end multi-asset class portfolios of my many different end investors perform, because that would be impossible, right? All that I can do to show my performance is look at my return and risk. If I feel like I don't want to take on a lot of risk, what did we say? We said I'm going to be leaning towards shorter duration, towards cash in my investments. Even if longer duration bonds are producing a better return, I might not want to go there because I might not want the risk involved. But if longer duration bonds are producing a higher return, what are you guys going to want me to do? Long duration, right? Because you don't have the extra risk. If the interest rate risk is diversified away, for you guys, you'd get the extra return of a long duration bond without any risk. But for me, my portfolio that I'm being evaluated on, I'm being compensated by, I keep my job through, has the risk inbuilt. So the tendency is for the fixed income manager to be a bit more hesitant to take on duration compared to what actually might be right for the end investor. So see why fixed income, it's really interesting in that it is different to equity in that sense. They don't have alignment on its own versus in a multi-asset class fund. So in terms of why duration doesn't need to increase total portfolio risk, so what this slide is saying is, why might this line be flat on the right-hand side? It all comes down to the correlation of equities and bonds. Now, on average, if you take a long time series, the correlation is about 0 on average. This is the US. I'll come to this graph in a moment. But this is in the US from 1880. So it is updated, but you can't really see it because that's 2010, so it's really short periods here. But so what we've got here is essentially 10-year rolling correlation between equity and fixed income since the late 1800s in the US, and what we had here was Australia and the world. So these lines don't exactly align because in Australian and world fixed income we don't have a history stretching back to the 1800s. But these are two fixed income markets. This is another one where we have the longest time series. So what you can see is that on average it's about 0. It's been negative in the current century, and it tends to be lowest when the equity market is doing the worst. Right? This comes back to why bonds are such good diversifiers of equities. Bonds will do a good job in getting rid of some of your equity risk. It won't get rid of all of it because equity is the risk, the dominant source of risk in portfolios. But bonds will get rid of a bit of equity risk, and equity can get rid of the vast majority of bonds' biggest risk, which is interest rate risk. Right, and it makes sense why that negative correlation is accentuated in times of economic decline, right? Because if the economy's bad, everyone's scared, there'll be a flight to safe assets, so the demand for things like investment-grade government bonds goes up. It also, so longer duration bonds, the other reason why it is not necessarily going to increase total portfolio risk is if you're a liability-driven investor. If you're a liability-driven investor and if you're a defined benefit fund and your end investors on average will retire 40 years from now, or let me think of a bond that exists, 20 years from now is a bit more realistic. So your investors on average have a retirement 20 years from now. You're going to choose between two bonds, a 5-year bond and a 20-year bond. in your assets to hedge your liabilities. You're not going to pick the 5-year bond, right? You're trying to find a bond that's as close as possible to your liability. Your liability has a 20-year duration. You want to find a bond that has a 20-year duration. By the way, a 20-year duration, if you guys, you don't need to know this, but if the duration's 20 years, is the time to maturity going to be more or less than 20 years? More. Good. Just checking. Okay, so if you've got a long duration of your liability base, you will want a long duration of your asset base to minimise your risk. If you're a long-tail insurance fund, you will want a longer duration asset base if you're trying to minimise your risk. If you're a short-tail insurance fund, right, if most of your payoffs are going to happen in the next couple of years, that's where a 3-year bond makes sense as a liability hedge, not a 30-year bond. But if you have a long duration in your liabilities, you will look to a long duration in your assets. Now, the last thing I wanted to draw attention to, in case anybody is confused, this chart of correlation, some of you might have noticed that there's negative values above the x-axis and positive values below. This chart is from the readings, and essentially it's been rotated around. I imagine drawing it on a piece of glass and rotating it round. The reason is the line here does mean a negative correlation between equities and bonds at the bottom and positive correlation between equities and bonds at the top. But have a look at the title of that graph, and can anyone tell me why there are negative values above the x-axis corresponding to a positive correlation between the two asset classes? What have we got? We've got changes in the S&P 500 and US long-term bond yields. So if you have a positive correlation between equity value and bond yield, what will the correlation be between equity value and bond value? Negative, right? That's why I wanted to use the same chart as in your readings, but that's why it's rotated round. I won't ask you that in an exam. It's just in case anyone's confused. The value of, let's take a value of negative 0.25. If the correlation between the S&P 500 and bond yields is negative 0.25, that means a positive correlation between equity value and bond value. So I'm going to draw that because it's one of those things that saying it is often not as clear as writing it. No, don't shut down. We've got equity and we've got yield. If we've got a positive correlation, whoa, okay. So let's try that again. There we go. If we've got a positive correlation between equity value and bond yield, then when equity value goes up, bond yield goes up. But remember, the bond, let's take a zero coupon bond. Bond price is face value on 1 plus r to the power of n. So when the yield goes up, what happens to the price? It goes down. So in other words, a positive correlation between equity value and bond yield means a negative correlation between equity value and bond value, or equity return and bond return. So that's what I've written as a note in case you're wondering in interpreting the graph. That's what that's saying there. But I won't ask you to draw a graph like that. I just wanted to provide a symmetry with your readings. Essentially, all you need to focus on when you interpret the graph is above the x-axis is a positive correlation in the two values, below the x-axis is a negative, like you'd expect. Any questions on that? So what I'll do is let's take a break now, because that's the perfect break point. And by the way, apologies, that is the other comment that came up in the course feedback. I do get distracted and wait way too long to give you a break. If I'm ever sitting there at 3:30 and I haven't given you a break, just remind me. It's 3:04 now. Let's come back in about 5 minutes and we'll keep going and look at credit. All right, guys, so we've looked at, if we go back to the exposures within fixed income portfolios, we've said that the biggest exposure is interest rate risk. So we've now looked at interest rate risk, shown that it's the biggest exposure in fixed income, but also said that it can be diversified away in the multi-asset class fund. The second biggest exposure within a fixed income portfolio is what we call credit risk, and that's going to be the next focus for today. Now, remember how I said before, what do we mean when we talk about taking on credit risk? And one of the definitions of taking on credit risk, or at least one of the examples, would be investing in junk bonds as opposed to investment-grade bonds. That's actually exactly where I want to start us off when we look at credit risk today. Up until now, when we've been speaking about fixed income and talking about interest rate risk, what we've been focusing on is a world where we're not yet considering the possibility of default. So essentially think about it as a relatively safe fixed income where you can trust that a borrower will repay you. But there is an additional risk in fixed income, and that is that the risk that the person that you lend to is not going to pay you back. They are going to default on their debts. Now, in Australia, the vast majority of our fixed income market is what we consider to be investment grade bonds where the probability of default is low. Once you move overseas, there is more junk bonds and therefore more exposure to what we call credit risk. So I wanted to start by introducing the credit ratings of one of the agencies, and that's S&P. There's three big ratings agencies. I chose S&P, one, because their ratings are easier to say when I teach as opposed to Baa3 and stuff, like Moody's. But the other one is S&P is very often quoted for a few different reasons, one of which is that they tend to move first when they make a major ratings change. For example, does anyone know what the US, what the country's credit rating is? Does anyone know what Australia's credit rating is? AAA, right? We're one of the few that is still AAA. Does anyone know what the US's is? AA. Does anyone, I don't even want to think about how old you were compared to me, but does anyone remember when it was downgraded? It was 2011. It was S&P that did it, right? S&P were the ones that said, look, I mean, we all know how much the US has in debt. S&P was the company that said, I don't think we can keep calling them AAA rated, and they moved them down to a AA rating. Now, a AA rating is still extremely strong, right? The US, it's still saying that the US has a very strong capacity to meet their financial commitments, but it was a big move to take them away from that AAA investment grade bucket. So within investment grade, what we have here is a list where as you go down the list, the probability of default goes up. So we say the credit exposure goes up, and with any kind of risk, if it's non-diversifiable, you should get a bit of a boost to returns. So as you go down the list, typically these bonds will offer you a greater return to compensate you for the probability of default. Within the investment grade bucket, we start with AAA, where you have an extremely strong capacity to meet your financial commitments. Australia still has a AAA investment rating. As I said, the US is AA, very strong capacity to meet financial commitments. That goes down to BBB, where you have an adequate capacity to meet financial commitments, but you're a bit more vulnerable to economic fluctuations. By the way, within each of these are pluses and minuses, like you could have a BBB plus or a BBB minus. The reason that this table has included BBB minus and BB plus is that those brackets, and don't worry, for this course I don't expect you to understand the difference between the minus and the pluses, but the reason they're there is to say that every possible rating to BBB minus is investment grade, and then every rating from BB plus down is what we consider speculative grade. Speculative grade, and I'm going to use these words interchangeably, so let me write them down. Speculative grade is also called, people will refer to it as the high yield space. Thank you. high yield space, and people will refer to them as junk as well. So if you hear speculative, high yield or junk, it's referring to the same thing. Once you move into the junk category, what you're essentially saying is that all of the junk bonds have a higher than average probability of default, or their probability of default. Why aren't you working? You are more likely to default than you are to not default. In other words, the probability is above 50%. Sorry, here we are. Okay, so everywhere in investment grade, you're at least more likely to repay than you're not. Once you move into speculative or junk space, you're actually more likely to default than you are to actually repay your debt in full. Now, you might think that there's not much in between the BBB minus and the BB plus ranking. But of all of the downgrades you could get, with the exception of actually defaulting at D, with all of the downgrades, that is actually the most significant one for a company. Does anyone know? Think about it. You are issuing debt, so you're borrowing. People are lending money to you. Does anyone know why it matters so much to stay investment grade as opposed to move into speculative? What happens when you move to speculative in terms of your investment pool? Yes, it's hard to borrow, but why is it hard to borrow? Lenders. Yeah. Lenders are worried that they're going to lose their money because there's a higher than 50% chance of default. And what you actually find as a result is that there are a lot of investors that it's within their mandate that they can't invest in speculative grade bonds, in junk bonds. Right? So first of all, the junk space is mainly dominated by institutional investors, not retail investors. So you go from investment grade to speculative, you lose your retail investors. Even then, there are institutions or funds, more specifically, where within their mandate it says that they can only invest in investment-grade bonds to protect the end investors. So if you get downgraded from AAA to AA or A to BBB, it's bad because it's saying you're less able to meet your debt obligations. But it's not fatal. But if you move from the bottom of the investment grade to the top of the junk space, there it can be fatal, because not only do a bunch of investors that are holding your debt have to sell your debt, but it's going to be very hard for you to borrow anymore. So it is a big deal to move into speculative. And then, of course, you go down the ratings till you get to D, where you actually are in default. And as you go down the ratings, the return that you get expands. Now, I'll come back to what that return is after I've defined the credit yield spread, right? Because obviously the credit yield spread is going to go up as you move down the ratings here. The credit yield spread is the difference in yields of two bonds where they have the same length until they mature, but they have different credit quality. So, for example, let's take A. Telstra's bonds are A at the moment, A minus, but they're sitting in the A category. What you'd do, if you wanted to figure out the credit yield spread for Telstra, you would take a particular tranche of bonds, perhaps bonds maturing in 2027. You would find Australian Treasury bonds that are also maturing in 2027. You take the yield on the Telstra bonds, subtract the yield on the Australian Treasury bonds, and the difference is your yield spread. I haven't looked it up in the past month. When I looked it up a few months ago, don't quote me on this, but Telstra yield was about 4% and the government bond was about 2.5%. So the credit yield spread was about 1.5%. Don't quote me on it. That is a memory. It could be slightly out, but it's pretty close, right? So you'd say for Telstra, all right, 4% yield, subtract 2.5% Australian Treasuries, your credit yield spread is 1.5. Obviously, if Telstra was lower down the scale towards junk, that spread would increase. The government Treasury isn't changing because obviously if it's an investment grade like Australia, it's AAA, it's going to be the same amount no matter what. It's used as our baseline. That's why the blue line is sitting flat as we go through. We're not saying that Treasury bonds are going down in credit quality. We're saying that that is the baseline, after which all of the lines above it, it depends on the bracket that you see here in terms of figuring out the yield. So the full yield spread is the red line to the blue. What you then do is you break it up into different components. If you're a AAA rated investment grade corporate bond, you have a very small yield spread. If you're a high yield bond, you have a very large yield spread. Now that I've defined that, before I go into the components, just to give you an idea of numbers, if you look at the high yield space, on average, the credit yield spread's about 500 basis points, right? So for a junk bond, you're getting about 5% higher yield than you would for a treasury bond. But to give you an idea of how volatile that is, in the peak of the GFC, the junk spread was about 2,000 basis points, right? That's 20% extra yield for a junk bond above a treasury, and they really were that risky. But back just before the GFC, in mid-07, it was 240 basis points, so only 2.4% above, right? So in the space of about a year, the credit yield spread on junk bonds went from 2.4% to 20%. So it can be very volatile and tends to get worse when the economy is, the spread gets bigger when the economy is worse. Now, if we break up what we see, the different lines here, the first thing to get from the blue to the green is just a risk premium, right? As you go down in credit quality, these bonds get riskier, so investors demand a compensation for taking on that extra risk because they're risk averse. The next three lines are actually additional amounts required as compensation for expected loss. So up to the green, that's just a risk premium. The green to the red is actually investors saying, I expect that I might lose that amount, so you need to pay it to me in advance to compensate me because it's what I expect to lose. The first thing is you've got the expected losses from default. Now you can see that the expected losses from default increase as you move towards high yield. So you might be thinking, look, it doesn't matter whether a company was AAA or was high yield. If they default, investors lose. They're not going to lose more just because they happen to be a junk bond when it defaulted, right? So why, if the cost itself, if the dollar amount, if the company defaults, is going to be the same across the grades, why is this line going up, the yellow line? The probability of default is increasing, right? So the losses from default would be the same if it occurs, but it's far more likely for default to occur if you're high yield, which is why the compensation for the expected loss is higher with it. You've got the expected cost of illiquidity, and remember, as you go towards high yield, illiquidity increases. This is a smoothed graph. If you were to be really exact, but it wouldn't be as pretty, you'd actually see a bigger jump up in between the bottom of the investment grade and the top of the high yield space. It's just that the graph has smoothed the line. And then you've got a bunch of you want to be compensated for the fact that there are fees to a manager, you might have researched what bonds to get, etc. So you can see an exponential increase in the credit yield spread as credit quality goes down. Are there any questions on this graph? So what I want to do is I want to go back to what I said before about the GFC and the credit yield spread. Because remember, we said that in 2007, just before the crash, the high yield, so the junk credit yield spread was only 240 basis points. But in the worst of the GFC, it went up to 2,000 basis points. So you can see that the junk spread is a lot higher when the economy is low. Now, when the credit yield spread goes up, what's going to happen to the price of the bond? It's going to go down. So you can see that when you're in junk bonds, the value of the bonds are going to be much lower when the economy is down. I actually want to take you through that argument officially and then show you how it works empirically, because this is why we say that high-risk credit is a little bit like equity. You can actually see a high-risk credit exposure, so a junk bond investment, as actually having an exposure very similar to taking on equity investments and having an equity beta exposure. What I want to do is I first want to give you the reasoning and then want to show you the empirical evidence. If you have a look at the economic intuition, when the economy is down, companies are not earning as much in revenue because people aren't spending as much on goods and services. When company revenues are down, their profits are down, all else equal. And when company profits are down, equity value drops. Why does lower company profits lead to lower equity value? Lower dividends, right? Price is the present value of future dividends. Dividends can only be paid out of retained earnings. So when profits are down, earnings are down, dividends are down, and therefore the value of equity is down. That's the equity side. Let's go to the bond side. When the economy is down, this first bit's the same. Revenues are down because there's less to spend on goods and services, so profits are down. When profits are down, the risk of default goes up. Why is that? Yeah, not enough to actually meet your interest payments. That's the risk. If the risk of default is going up, remember what's going to happen to the credit yield spread. As the default risk goes up, the credit yield spread rises. So we've got a higher risk of default and therefore a higher credit yield spread. And remember, you guys just told me when the credit yield spread is higher, bond values are lower. So what you can see is when the economy is bad, equity values are down and bond values are down as well. That's the first thing to understand. The second thing to understand is which part of equity and which part of the bond market is particularly vulnerable to this. Now, the equity side we know because it is the very definition of beta, right? If you are a high beta equity investment, when the economy goes up, you go up by more. When the economy goes down, you go down by more, right? High credit risk stocks, though, are exactly the same because have a look at that second dot point. When the economy is down, profits are down, so the risk of default or bankruptcy goes up. But if you were of a high credit quality, all right, your profits are down, but you have no problem meeting your debt obligations. You were meeting them fine before, you might be a little bit tighter, but you can still make your interest payments. But when the economy is down, and you are already highly vulnerable to actually being able to make your interest payments, then when the economy is down, you're struggling to meet your debt obligations, now your profits are down. If you weren't meeting them, if you were struggling to meet them before, you're not going to meet them now. So the ones that are really vulnerable to the economy dropping in terms of the ability to repay your debt are the ones with a low credit quality and a high probability of default. Right, so it's the junk bonds that are very vulnerable, their values are very vulnerable to fluctuating economic cycles. And it's the high equity beta stocks whose values are particularly vulnerable to the fluctuating economic cycles. So they end up being one and the same. So that's the economic argument. We actually see it empirically in the data as well. What you see is that if you have a corporate bond with a low credit rating, the equity beta of that bond is actually quite high. Let me show you what I mean by this. This is again from your readings. What we have here is a bunch of different bonds that we are going to regress on an equity index, the Russell 3000. The slope of that regression is the equity beta of the bonds. So we're calling it an equity beta. What we mean is the sensitivity of the bond value to movements in the equity index. If you have a look, let's take the whole period. Investment grade, at the top of the investment grade, we've got a 0.05 beta. That's nothing, right? So essentially, the Russell 3000 can be going up and down as much as it likes. It's not affecting the value of the investment grade bond. Once you move down, as you move down, the equity beta rises. And once you get to the grade just above default, we've got a 0.72 beta. So in other words, if you're a junk bond that is very likely to default, when the Russell 3000 goes up by 1, your value goes up by 0.72. When the Russell 3000 goes down by 1, your value goes down by 0.72. We have a bond that's essentially acting like a stock, right? So that means that it is behaving like equity. So its risks are going to be very similar to equity because it's fluctuating with the equity markets. So you know how we said that fixed income is a really good equity diversifier? we're talking about your investment grade fixed income. Once you move towards your junk grade, it's essentially acting like equities. So its ability to diversify equity risk goes down with it. And if you look at the recent sample period of the study, where you can actually evaluate the category that is in default or very close to in default, we have a beta of 0.95. I mean, that is a bond that is equity. You just call it a bond. And it acts a bit like a bond, but it's really not. Okay, so as you move into junk, your bond will have less properties like fixed income and more properties like equities. So the reason I want to show you that is to take you to the second risk, credit risk, and how it will differ depending on a fixed income portfolio alone versus a multi-asset class fund. And for the fixed income manager, this one is really cool. Let's say you're so you guys can be the fixed income managers now. You are evaluated based on your returns and your returns only, right? You're not evaluated based on a multi-asset class fund. You are trying to decide the mix of your fixed income investments. How much investment grade and how much junk should you take on? Ignore the graph on the right, look at the one on the left. What we have here is 100% investment grade and no junk. The weight in junk is going up to this side where we have 100% junk and no investment grade bonds. What we have on the y-axis is the volatility of your portfolio. Now, before you look at the line, remember that previous graph here. As credit quality goes down, the required return on your credit investment rises with it. So as we move from left to right, the return we get is going to go up. It has to, because it is a compensation for added risk. This is what's so cool. Let's pick the more recent line, so the red one, not the maroon. If you go from 0% to about 40% junk, as you increase the amount of junk you have in your portfolio, not only are you boosting your return, you're actually reducing your overall portfolio risk. Right? This is what never happens in investing. It's like paying for a Mazda and getting a Porsche. You've got not only better returns, but you've got lower risk with it. Once you move past 40%, yes, your junk risk will dominate. And obviously, if you have 100% junk, you've got a lot higher risk in your portfolio than if you have 100% investment grade and 0% junk. But for this bit, you've got a sweet spot where at about a touch under 40% junk and a touch over 60% investment grade gives you a return boost and a risk reduction as well. So you guys are fixed income managers. Forget about your end investor. Just focusing on your fixed income portfolio, you're going to want to sit at the bottom of that curve, right? You're going to want to have a bit of high yield to give you the return benefit and the risk reduction. Can anyone, in fact, I probably can't ask this because I've probably written it here a little bit. All right, let's tease this out. Why are we reducing risk here? First of all, what are we diversifying away that's enabling the total portfolio risk to go down? Interest rate risk, exactly. Remember, the biggest exposure in a fixed income portfolio is interest rate risk. Remember, high yield bonds act a lot like equity. And do you remember what we said about equity's ability to get rid of interest rate risk? What we're doing here is we're introducing bit by bit a bond that behaves a lot like equity. So in this space, bit by bit, we're getting rid of more and more of our interest rate risk. At a certain point, we've diversified our interest rate risk away, and so you're not going to get any more risk reduction because we've got rid of interest rate risk and now we're just adding in credit risk. But the beginning bit, the drop in that line, is because we're adding in a bond that has a higher correlation with equity than it does with an investment grade fixed income instrument. So we're bringing in something that's a lot like equity risk and getting rid of our interest rate exposure as a result. Now if we move to the graph on the right, we have a multi-asset class portfolio. Within, and in this case we're looking at a world fixed income investment, we've got 13% world fixed income. Within that, what we're doing is we're increasing the amount of high yield in that 13% and reducing the amount of investment grade. So here the 13% is all investment grade. Here that 13% is all high yield. There's no drop. For every amount that you increase your high yield exposure, so your junk bonds, all you're doing is increasing the volatility of your overall portfolio. You're also boosting returns a bit, but you're increasing risk with it. In other words, you're not improving the risk-return trade-off in that beautiful way you were on the left. Why is it that if you bring in high yield here, you're not reducing your risk? Yeah? And what has equity done already? Exactly. Right? We've already got equity in the portfolio. Equity's got rid of our interest rate risk. We can't get rid of interest rate risk more than making it disappear, right? You can't have negative interest rate risk. Equity has taken the interest rate exposure to nothing. So by adding in high-risk credit, you're adding in essentially more equity exposure. So you're not getting the additional benefit. All of the benefits been taken up in terms of getting rid of fixed interest rate risk. Now you're just adding in another equity-like investment and increasing the risk of your portfolio as a result. So now we've got a different conflict of interest. Remember, you guys were the fixed income managers. You wanted to sit at about 40% in your portfolio because not only did it boost your returns, it also reduced your risk. And you're evaluated just based on this portfolio. Let's say I'm now the end investor. All right, I'll admit that a bit of credit exposure might boost returns, but it's not reducing my risk. So I don't have the same benefit to that 40% high yield weighting that you guys do as a fixed income manager in isolation. So here, the risk is that the fixed income manager will want to take on more credit exposure than your end investor might like. Again, conflict of interest. And just wouldn't happen with equities. It's what makes fixed income so unique. Any questions on that? Now again, I don't need you guys to memorize the numbers or anything like that. I would like you to know that 30–40% vague range. You don't need a specific number, but it is important to realise that a bit over a third of your portfolio in high yield, if it's a fixed income on its own, is actually a sweet spot in terms of risk reduction and return enhancement. But if I asked you to draw it, I wouldn't need exact numbers. I don't want you to remember the 8.4% or anything. I just want you to understand the shape of the line. And as you can tell, I get pretty excited by this, so it does come up in my exams from time to time. So what we're going to finish with today is looking at ways to access fixed income markets and a couple of strategies. In terms of accessing the fixed income market, it is an institutional market. So if you're a retail investor and you want to take on a fixed income exposure, you will typically do it through that aggregator side of the market that we looked at in week 1. So you'll give your money to an aggregator, they will pull the retail investors' money together and invest in fixed income on their behalf. In terms of what type of portfolio management you might want to get when you give your money to a manager, there's a whole bunch of different breakdowns. I don't expect you guys to go into them in any great detail. I just want you to be aware that they exist. There's cash and enhanced cash. If you're a cash fixed income investment, what type of thing would you be looking at? 3 to 6 month T-bills. Enhanced cash, most of your portfolio is in short-term treasury bills, but a small proportion of that portfolio will be invested in higher risk corporate credit, so things like junk bonds, to give a boost to returns. Or it might even be that you're putting it in investment grade bonds, but right at the bottom of the bucket of the investment grade bucket. So that way you're still getting that bit of a boost, but you're not yet in the junk space, depending on the mandate of the fund. If you're a passive fixed income fund, you will attempt to track the fixed income benchmark. Same as same as passive equity, where you attempt to track a passive equity index. But in fixed income, that's actually more challenging, and we'll come to that next. If you're a traditional active fixed income fund, you're just aiming to outperform the fixed income benchmark. Arguably, that is easier to do in equities for two reasons. One is that fixed income markets are a bit less efficient, but the other is that it's a lot harder to separate luck and skill in fixed income because you don't have the good alpha models. So you can, for example, play with things like duration and credit exposure, and it's a bit harder for your investor to say you're just taking on risk because it's harder to identify how much return is due to risk and therefore what's left for skill. You have a core plus mandate. These are becoming they're becoming more and more popular. In a core plus mandate, the majority of your fund is benchmarked to and tracking a passive index, but a small proportion is invested in returns to give you an uplift. So, for example, you might, in Australia, be benchmarked to the Bloomberg Oz Bond Index. So the majority of your investment might be tracking the Bloomberg Oz Bond market, but then a small proportion of your investment might be invested overseas in order to gain access to higher risk corporate credit that will give you a bit of a return boost. And remember what we said, if you're a fixed income portfolio in isolation, taking on that bit of corporate credit will increase your return and reduce your risk at the same time. You have sector specialists, so you might have funds that only invest in high-risk credit, funds that only invest in asset-backed securities, only invest in emerging markets, and so on. You have hedge funds. We're going to look at that in week 9. That might be, for example, we'll look at fixed income arbitrage or long-short credit. And you might have a structured, separately managed mandate. So you might have a big defined benefit fund that says, I want you to calculate the duration of my liabilities and invest in a portfolio of fixed income assets that matches that duration. Or they might say, I want you to give me a targeted corporate credit exposure in these specific emerging markets. Obviously, if you're going to create a structured mandate for one investor, they are a big investor that will offer you a lot of money to do it. So remember I said that it can actually be quite difficult to track a fixed income benchmark and to be evaluated against a fixed income benchmark. And that's because really fixed income indices are far less nice to work with than they are in equities. The first issue with managing to a fixed income index, so for example, let's say that you're going to be evaluated based on your performance relative to the Oz Bond Index in Australia. The first issue is alignment with investor objectives. So, for example, we've seen that the impact of duration is going to have a very different impact on a fixed income portfolio in isolation compared to the multi-asset class portfolio. If I'm evaluated compared to the Oz Bond Index and I want to reduce my risk relative to that index, I might want to scale my duration back to less than the index duration, and that's going to take the edge off my volatility. But the end investor doesn't care about interest rate risk. They've diversified it away because they've given some of their money to me, but money to equities, commodities, property, whatever. So for them, if taking on longer duration has an upside in returns, they want you to do it, but you're hesitant because you have the added issue of risk. Credit, same thing. If you're benchmarked to the Oz Bond Index, one way to outperform the Oz Bond Index, because it doesn't have a lot of high-risk credit, is to put a lot of your investments, within Oz Bond, but then put some as well in the higher-risk corporate credit markets overseas. That's going to give a boost to returns and potentially an edge off your risk as well, because you're evaluated in your portfolio in isolation. Okay, so that creates a lot of issues. So essentially that first point comes back to those two different pairs of graphs that we went through. The second is that risk isn't accounted for very well in fixed income. Sometimes they don't actually adjust for risk at all. When they do, the methods will vary a lot depending on the fund, depending on the market. There often isn't a very good theoretical model behind it. When they do look at it, they tend to look at things like value at risk, which only looks at the fixed income portfolio. And we know that the risk to the fixed income portfolio isn't necessarily the risk to the end investor. So you don't account for risk very well. And even if you want to be passive in fixed income, which you might argue is lower risk compared to active, the fixed income indices that you would aim to track have a lot of issues involved. The first issue with fixed income indices like the Oz Bond Index is that they're not a very good guide. They're not a comprehensive guide to all of the possible investments out there. Right? If you track an Oz Bond Index, you're going to get a lot of investment-grade government securities, but you're not going to get a lot of corporate credit exposure. So if you're, for example, a fund that can go off benchmark, if you're evaluated against the Oz Bond Index, but you don't need to track it exactly, the easiest way to outperform the Oz Bond Index is to go and get a bunch of corporate credit exposure, because it doesn't exist in your benchmark. So it becomes quite easy to beat if you're active. The second issue is that the fixed income indices are always changing. Think about the S&P 500 in the US. They're the 500 largest stocks by market capitalization, and equities are assumed to have an infinite life, right? They last forever. So there's not a lot of movement in index composition. Now think about a bond index. If you've got a 5-year bond index in the index, if you've got a 5-year bond in the index right now, in a year it will be 4 years, and in 4 more years the bond will disappear. Right? So a 5-year bond will only be in the index for 5 years at the most. So they're always fluctuating. The composition of the index is always changing, which means the exposures are often changing with it. And it's always going to depend on who happens to be issuing debt at the time. If you've got a global fixed income index and one particular country starts issuing a lot of debt, they will probably dominate that index for a few years, but they might not dominate it 10 years from now because a lot of their debt may have actually matured. And that actually leads to the third point, and this is a really big problem with the indices. They're issuer-driven. They're cap-weighted, right? The S&P 500, the stocks with the highest weighting in the S&P 500 are the largest stocks, right? Because it's a market capitalization-weighted index. There's nothing inherently risky about large stocks. In fact, if anything, Farmer and French argue small stocks are more risky than large stocks. So in the S&P 500, there's no problem with the fact that you're going to put most of the largest proportion of your money in the largest stock in that index. In a fixed income index, you're going to put the largest proportion of your money in, let's say, the company that is issuing the most debt. What's the problem with that? Default risk, right? You're essentially putting the largest amount of your money in the companies that are borrowing the most, and if they're borrowing the most, they might be struggling to repay it because they have more leverage. So it's tilted towards the more highly levered companies, and therefore the companies with a higher probability of default, all else equal. So, for example, a few years ago, Japan was issuing a huge amount of government bonds. So that means that they were a very large weight of a lot of the world fixed income indices. But the fact is they were very highly levered at the time. And they still are. They still have a high debt level. They're hard to replicate, particularly if you come in after the indice has already existed, right? Because remember, when you come in to track an index, you need to then buy all of the investments that exist in that index. But what if we said tends to happen when bonds move off the run? They become less liquid. So you come in, you need to buy a bunch of bonds. Some of these bonds might have been in the index for years. And so they're going to be quite illiquid. Some of them might be over the counter. It's going to be very hard to mimic the index exactly. And if you do, you typically need to pay an extra amount because of that illiquidity. And the last one is a conflicts of interest issue, and that is that a lot of the indices are actually supplied by investment banks. Right? The Bloomberg index used to be the UBS index until recently. So if you are UBS and you're creating an index and you're deciding what bonds go into that index, and you're also issuing bonds, what are you going to do? You're going to put your bonds in the index, right? Because if you want to borrow and you want a lot of people there willing to lend to you, and you know that you're creating indices that a bunch of investors have to track because they're passive, you're going to chuck your own bonds in there, and suddenly people have to hold your bonds if they want to be passive against that index. So obviously they have an incentive to put more of their own bonds in the indices that they create. So a lot of issues with managing to fixed income indices that don't exist in the equity space. I don't expect you to know any of these in detail, but I wanted to list some of the different products out there just to give you an idea of the range that exists. Right? You might, if you want to invest in fixed income, you might invest in government bond, you might invest in corporate credit, be that investment grade or high yield, and we've seen they can perform very differently. You might invest in any of what we call the alphabet soup. I don't expect you guys to learn all of those, but you've got asset-backed securities, mortgage-backed securities, commercial mortgage-backed securities, collateralized mortgage obligations, collateralized loan obligations, collateralized debt obligations, and collateralized debt obligations squared, which is a CDO backed by a bunch of CDOs. Right? With each different version of this alphabet soup, you have slightly different features, and they're all ways to essentially tranche risk and pass on risk and pool risk and repackage risk. And the trouble with the GFC, with the credit crash, is they became so complex that no one really knew who bore the risk. And as I'm sure I've told you before, the trouble is, because it was so systemic, even if you didn't hold a single one of these instruments, when the GFC hit, everyone's portfolios dropped. So the answer was everyone bore the risk. They just might not have known it because they didn't hold a structured security. And even if they did, they might not have properly understood it. So they might not have realised they had as much risk as they did. You might invest in the debt of emerging markets. You might invest in bank loans. That's when a bank will lend to someone and then they won't want that loan on their books anymore, so they sell it. So you essentially take on, let's say, so I borrowed from Commonwealth Bank. If you purchase that bank loan, I now need to repay you instead of the bank, essentially. You might have inflation-linked bonds. They're the focus of a tute in a few weeks, so that they could also be called index-linked, indexed or inflation-protected bonds. And there's a bunch of derivatives over fixed income instruments as well. Again, you don't need to know the details, but I just want you to understand that there's a lot of options out there to invest in. And the last thing to consider is strategies. Now, I don't want to rush through this, so I'm just going to talk about the top one, and I'll finish this last little bit of the list in the workshop tomorrow before we go into the assignment. But essentially, strategies can be anywhere from security selection to market timing. And I just want to tell you today interest rate anticipation, because you could define this for me already. You did at the start of today. Remember, interest rate anticipation is if you think interest rates are going to rise, then you expect bonds to fall in value in the future. So you will sell bonds before they do. If you think interest rates will fall, you will buy them because when interest rates fall, bond price rises. So you buy the bond now before the rate falls and therefore the bond price rises. I haven't read it. You buy bonds when you, okay. Oh yeah, I have, thank you. Oh my, you know how long I've been teaching with this slide? Like, that's actually really scary. You sell bonds in an anticipation of interest rate rise, because when interest rates rise, the bond price falls, and you buy bonds in anticipation of an interest rate drop, because you want to buy them before the rate drops, and therefore the bond price rises. I will save that properly in Waddle. Thank you so much. Now, we're going to go through the other ones at the start of the workshop tomorrow for about 5 minutes, and then we'll go into the assignment. Thanks, guys. Hey, how are you going?
Thanks, how are you?
Good. I'll just start this.
I have 2 quick questions.
Yeah.
The first was, I missed the first 5 minutes of the lecture. Did you mention anything about the mid-semester?